This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on scalping. I would like to begin by talking about the difference between a limit order market and a stop order market. A trading range, especially if it's tight, is a limit order market, and traders should only be trading it if they're scalpers and willing to enter with limit orders. Next, I want to talk about the personality that successful scalpers have. Most people do not have that personality. And don't worry about it. Most profitable traders do not have scalpers' personalities, yet they still can make a lot of money. These charts look fairly similar. They're obviously in a trading range, but there are some differences between the two charts. For example, look at the open of this bar and the close of that bar. It's above the close of this bar. That means that traders, as soon as this bar closed, hit buy the market, and they get filled above the close. Look at the open of this bar and the close of that bar. Again, no overlap. Traders are eager to sell. There's an urgency here. The bars are not overlapping very much on the way up or down. It entered much more of a tight range here, but overall, there are more legs with very little overlap and more of a sense of urgency. This market is a better market for entering with stop orders. On the other hand, look at this chart. The open of this bar is at that close, but the low of the bar fell below that close. And here, we closed here, and the next bar opened lower. That means that traders sold the close. As soon as this bar closed, they hit sell the market, and the market ended up going sideways. Lots of bars going sideways, lots of bars with prominent tails. I refer to this type of a market as a limit order market, and traders who are trading it, in general, are scalpers. We have several microchannels in this market, even though it's a trading range. Most of the bodies are big, they do not overlap much, and we have several areas where we have consecutive, decent-sized trend bars. Traders in a market like this can enter with any kind of an order, stop orders or limit orders. You can scalp this market with limit orders, selling above bars, buying below bars, but you can also enter reversals with stop orders. When it's low, you look to buy a reversal up. Here you have a micro double bottom, down, up, a decent buy signal bar, you buy. Here we have 3 decent bull bars. Probably the first pullback will be bought. Some traders would buy with a limit order below the low of this bar. Others will simply sell with a stop above the high of this high 1 buy signal bar. Small bull trend, pullback, so it's a small bull flag, buy with a stop above its high. Experienced traders will buy with limit orders or market orders. The strong close of a bar, they'll buy. Strong close of a bar, they'll buy. Disappointment here, and you can see what took place here. The bulls did not like seeing a doji bar, and then another doji bar, and a lot of them placed limit orders to try to get out break even at that close. And experienced traders did it. Others waited, they get out here or here. Reversal down, second reversal down, tried to reverse down, could not, tried to reverse down again. Reasonable to sell. Limit order traders. Here we have a low one after a bear trend at the bottom of what is potentially a trading range. Big up, big down, big confusion usually means sideways, a range. Traders will look to buy below bad sell signal bars. A bull body, a doji, a bad sell signal bar at the bottom of a range. So traders will place a limit order to buy at the low of the bar. Strong bull bar closing on its high after a bull bar closing on its high. Scalpers will buy that close, they'll buy that close. Is this going to be a lower high leading to a reversal? Not likely after 3 consecutive bull bars, and therefore it's a bad sell. Bull scalpers will place a limit order to buy at the low of the bar, and they'll get filled here. Reversal down from the top, a parabolic wedge, push up, and then a bear bar. 3 bars up, and then a bear bar. 2 bars up, and then a bear bar. Trading range, up, down, up. Traders will sell with a stop below that bar. Here we have a double top, lower high, a double top bear flag after a very tight channel, almost a micro channel. Traders will sell the double top bear flag. We went up and then down. We went up, maybe we'll go down. We're near the top of a potential trading range. We have a parabolic wedge. You expect 2 legs down. 1, pullback 2. Here we have a wedge bear flag. We went up and then down, and then up and then down, up. And now we have a bear bar at the moving average. Strong, big bear trend bar. A breakout test of the bottom of this upper range. Traders will sell with a stop below the low of that bar, looking for at least a scalp down. Traders will sell with limit orders or market orders. A pair of strong bear bars, room to the bottom of the range, they'll sell. We have 3 consecutive bear bars after a parabolic wedge. Traders expect at least a small second leg down. 1, pullback 2, and they'll sell with a limit order at the high. Here's a high 2 buy, high 1, high 2, but 3 consecutive bear bars. Traders will sell above that bar, betting that even though this has 2 legs down, 1 pullback 2, the channel is so tight, it's probably the first of a more complex, bigger 2 legs down. 1 pullback, and then 2. On the chart on the right, look how prominent the tails are. That means the market tried to trend, it reversed. It tried to trend down, it reversed up. Tried to trend up, it reversed down. Very tight trading range. Reversals coming every 1 to 3 bars. Most traders should not trade when they see the market looking like this. It's too easy to lose money. However, a professional scalper feels very comfortable in this kind of a setting. If they make quick decisions and they can enter with limit orders, and especially if they can scale in and use fairly wide stops, they can make a lot of money even when the market looks like this. Most traders should not be trading that. But professional scalpers will look at it and say, we get tight trading ranges all the time. I'm here to make money. There's opportunity here. I can do it. They'll bet that every attempt to turn into a trend will fail. At one point, this big doji bar was a big bull trend bar, and the scalper bet that after 2 bear bars, both with fairly prominent tails, the breakout will probably fail. We went down, we went up, we went down. We're going up. Scalpers will bet that it's a bad buy above a bear bar. They'll place a limit order to sell at its high, looking for a scalp. They'll also place a limit order to sell above this high in case it kept going up. They'll sell more here, expecting a scalp. They'll sell more above this bar. They'd be selling over here. I don't have it indicated, but they would. 3 bars down after a buy climax, traders will sell above a bull bar, especially one with a big tail, betting that the best the bulls will get is a trading range, enough room for a scalp. They sell here. They buy back their shorts near the bottom of a potential double bottom at the moving average. They'll also buy with limit orders. A fairly big bear bar, but also prominent tails top and bottom. They'll look to buy at the bottom. Here we have an entry bar after this reversal, down and then up. Bulls will buy at the low of that bar, betting that the first breakout will fail. They'll buy the close of this bear bar, betting against consecutive big trend bars. They'll bet that every time the bears try to get a trend, they'll fail. They might get a couple bear bars, but they're unlikely to get 3. For example, 2 more bear bars, they'll buy here, the close of this bar, betting that the bears will not be able to turn this into a trend. Consecutive bull bars, they'll sell. Also, they're selling at a prior high, looking for a scalp down. Here, we're trying to get a reversal down, but only a doji bar after 2 bull bars. You have to be very quick to understand what's going on and to make the decisions and to place the orders, and you have to manage the trade quickly. You got to make sure that your profit-taking order and your stops are in the right place. Traders will also scale in higher. For example, if a bear saw this pair of bear bars, prominent tails, trading range, they'll place a limit order to sell at the high of this bar, but they'll also be willing to sell more higher. The second entry has to be at least as big as a scalp, because a lot of these scale-in traders are looking to take profits around their original entry, and they want to make at least a scalper's profit on the second half. They get out break even on their first, and they get a scalper's profit on the second. The same here, a pair of bear bars. It's fairly low in the range to be selling, but traders might sell above its high, sell more higher, at least the size of a scalp above, expecting the market to pull back below the high of this bar, which it did right here. And then they get out break even on their first entry. They sold at this high, and then they get out with a scalper's profit on the second entry. And part of the reason this reversed is bear scalpers were buying back their shorts. I talk about swing trades and scalping with stop orders in other videos like trading the open. I'm not going to talk about that much here. I'm going to talk much more about limit order and market order trades in trading ranges and in broad channels. A broad channel is basically a trading range that's tilted up or tilted down. When the market's clearly trending fairly strongly, not much in terms of overlap, not much in terms of prominent tails, most traders will consistently make much more money if they swing trade. Look to enter early, A bear flag, a low one bear flag, sell. Low one bear flag, sell. Up, down, up, down, up. A wedge bear flag at the moving average, sell. We have a higher low major trend reversal, 4 consecutive bull bars, almost a bull bar here, 8 consecutive bull bars. Traders will look to buy either a high 1 or a high 2. Bear breakout, with the bulls trying to have a bull flag here after this small rally. Instead, we got a bear bar and a second consecutive bear bar, confirming the breakout. This is follow through selling. Traders will sell. Here we have a higher low major trend reversal, and we have 3 consecutive bull bars. Bulls will start buying closes. They'll buy the close of this bar, any of these bars, confident that the first reversal down will be minor, become a bull flag, and the market will resume up. If you take a sell for any reason anywhere in here, even if you sell here, your stop is up here, the top of the most recent strong sell-off. And every time you get a new breakout to a new low with a reasonably strong sell-off, traders will tighten their stops. Once this bar closes, the bears who sold for any reason through here will lower their stop from here down to here. And the same is true here. No matter where you sold, if you sold here, if you sold below that bar, if you sell below this bar, once you've seen 2 or more consecutive bear bars closing near their lows, breaking to a new low, traders will lower their stop to above the most recent major lower high. It's major because traders will consider the bear trend intact as long as it keeps making major lower highs. If it gets above a major lower high, traders will assume the bear trend has ended and the market has evolved into either a trading range or possibly even a bull trend. Here's a major lower high and the market rallied above it. We already knew that it probably was a bull trend before it got above that high, but once it does get above that high, the bears give up their premise that it's still a bear trend. They assume it's either a trading range or now a bull trend. If you are swing trading, you continue to hold your position until either your stop gets hit or until there's a reasonable opposite signal. You can argue getting out at the bottom here makes sense. 3 pushes down, 1, 2, 3, a possible wedge. A lot of traders will exit not above this bar, but above a bull bar here, or after they believe the market is trying to convert into a trading range, forming a higher low major trend reversal. A lot of the bears will exit here. And here, the bulls might exit here. 3 pushes up, 1, 2, 3, or 1, 2, 3, and a bear bar, knowing that a bear channel usually evolves into a big trading range. We have a spike pullback channel. We're near the top of the channel, and it's a logical area for the bulls to take profits. And therefore, if you have any kind of a wedge top and a decent sell bar, decent bear body, bulls will take profits no matter where they bought. Just because bulls take profits does not mean the signal is strong enough for the bears to sell. If the channel is tight like this, the bears will wait in general for a second signal. They won't take the first signal. But the first signal, especially when the location is near the top of a possible developing trading range, is good enough for the bulls to exit. And if the market resumes up, they'll buy again. In the E-mini, if a trader took this sell and sold the close of the follow-through bar after the bear break below the bull flag, it's reasonable to exit on this reversal up. You have a small double bottom or a wedge bottom, 1, 2, 3, and we're starting to get trading range types of bars, smaller bars, doji bars, prominent tails, and sideways. The strong trend might be ending. If a bull bought here, and as I said, a wedge near the top of the channel, possible trading range, it's reasonable for a bull to take profits here with 10 points. We're starting to get smaller bodies, a lot of overlap among the bars. It's entering a tight trading range. In fact, you could call this whole 40 or 50 bars a tight trading range. When there is no clear trend, many traders either scalp, experienced traders will do that, or they wait for the next trend. For example, a higher or low major trend reversal, higher probability to buy after you see a series of bull bars, consecutive bull bars closing near their highs, but a reasonable buy here as well. A wedge higher low, bear bars, bull bars, bear bar, bull bar, bear bar, bull bar, 3 pushes down to a higher low. I've been talking about a lot of scalps in trading ranges in which you're buying near the bottom, betting that the bear leg will fail and reverse up. You're selling near the top, betting that the bull leg will fail and reverse down. Scalping in the direction of a strong trend is also a good strategy. One of the problems scalping in a strong trend is scalpers tend to take their profit and then take a break for a bar or two or three, and then they miss the next scalp. And they end up taking far fewer scalps than what you see on the screen. And they'll end up making far less money than a swing trader when the trends are strong like this. When you're scalping, you're going for a small profit. And that means you need very high probability to offset the terrible risk reward. For example, if you're selling this close for a scalp, it doesn't matter whether you're selling for a scalp or a swing, your stop is still up here. The swing trader is going to hold for a big profit. The scalper is just looking for a little profit. A scalper taking that much risk for this profit, in general, is better off if he's willing to scale in higher in case the market goes up near his stop. That's one way to increase the probability to offset the bad risk reward. Usually, the risk is at least as big as the reward, and therefore you have to be winning 70 or 80% of the time for this to be a profitable strategy. That is very difficult for most traders to do, and therefore most traders should not scalp. A trader can consistently make a good profit scalping if he takes high probability scalps. There are not many that are high probability without proper management. For example, using wide stops and scaling in. For example, the bear who sold the close of this follow-through bar after the bear breakout has a stop up here, did not pull back very much, and here he can exit with 2 points profit. And when you look at that, he sells here and buys back his shorts here. He made very little compared to the size of the trend. Also, compared to the size of his risk. Not an ideal way to trade. Just because mathematically it might make sense to take profits here does not mean that it's the best solution. In general, going for the minimum for anything in life is a bad idea. Hoping to make minimum wage for your career is a bad idea. A bear who sells below here, a wedge bear flag, a low 3 short, low 1, an attempt at a low 2, and then a low 3 at the moving average, puts a stop above the top of the most recent major lower high. We have a series of bear bars, 2 of them pretty good size, closing on their lows, and a new low. If this is still a bear trend, it should not get above a major lower high. It certainly should not get above this lower high. This is a reasonable location for a stop. This is a higher probability. In general, when you use a stop that's further away, it's not going to get hit as often, but when it does get hit, you're going to lose more money. Both are reasonable. Stop here at the top of the wedge channel, 1, 2, 3, or stop here at the top of this small major lower high. If you take this trade 100 times using the tighter stop or using the wider stop, you'll end up with about the same amount of money. A trader could buy this close knowing it's the third consecutive bull bar after a higher low major trend reversal, and the market's probably going higher. If he takes that buy, he has a high probability of making money putting a stop down here. And he could exit here, a 2-point profit, a small scalp. But when you look at the size of the swings on the screen, going for a 2-point scalp here and going for a 2-point scalp here just looks too small for the size of the risk and for the size of the profit potential. Most traders should not be doing that. Professional scalpers who do buy, exit, buy, exit, buy, exit can do very well. Sell, exit, sell again, and then exit. And they just repeatedly sell. But that is very difficult to do. It's very difficult to get out and then immediately get back in or get back in a bar or two later. It sounds good, but it's very difficult to do. And very few people can do that. It's much better when you see a market having a reasonably good swing and a likelihood of having a swing, hold for a swing and rely on your stop. A bull scalper, we have a bull channel, a bear breakout, probably will fail. High 1, high 2 at the bull bar, you buy above, exit with 2 points. That's another example of a scalp in the direction of a trend. This video, I'm not going to be talking so much about the trends. I'm going to be talking about the trading ranges and scalping within those ranges and during the transitions from a trend to a trading range. A lot of the time, the environment is much better for scalpers, and most traders should not be trading. When the market looks like this, swing traders are not making money. They're not making money here. They're not making money here. They are if they're hoping for trend resumption up. But in general, these are areas where scalpers can make a lot of money. The tighter the trading range, the less likely swing traders will make money. And the more bars they have to hold while they wait for a trade to become profitable. For example, if you're a bear holding short down here, let's say you sold anywhere in here, and you're hoping for a profit, it's still below the most recent major lower high. We still do not have a credible buy signal, and therefore you end up holding for 10 bars, 20 bars, waiting for your premise to play out, waiting to make money. And that's just part of the game. If you're a swing trader, that's what you're going to do. Scalpers look for trading range environments, and then they bet against breakouts. Here we have a strong bear breakout to a new low. Here's the breakout point. Look at this. Look at the high of this bar and look at the low of that bar. Do you see what took place? The market went above the high of that bar. Therefore, pullbacks are going above breakout points. And what does that tell you? It tells you that a bull who either bought this low and bought more lower could make money. He buys at this low. He buys more, at least the size of a scalp lower, and then places a limit order to get out into his first entry. He gets out break even there, and then with a profit on his lower entry. This is what I call a stairs pattern. Whenever you're in a channel, but the pullbacks are overlapping the breakout points, that tells you that traders buying below the bars are making money. It also tells you that the bears are taking profits below every new low. This is a good environment for scalpers. As the trend goes on, remember the market cycle. Initially you have a breakout and then a channel, and then the channel gets flatter. It transitions into a trading range, and then either breaks in the opposite direction. Here we have trend reversal, or it resumes down. You get another breakout and then another channel and another trading range. When you start getting stairs patterns, you know the bulls are making money in a bear trend, and therefore it's the earliest sign that the market might be soon transitioning into a trading range. Some bulls will buy the low and buy more lower. Others, instead of buying the low, will simply buy lower, the size of a scalp or twice the size of a scalp, expecting the market to come back above the breakout point. A lot of scalpers do not do that until they see a stairs pattern. For example, would I buy below this bar or this bar? We don't know if this pullback overlapped the breakout point, but let's say it did not. Let's say the prior low was here and there's a gap between this low and that bar. That is not a stairs pattern. We're getting gaps, possible measuring gaps. Traders are much less willing to buy prior lows. However, once you see a pullback going above a breakout point, the scalpers start to trade. They start to buy at the prior low and lower, or they simply buy lower. If they bought that low and bought more lower, at least the size of a scalp, if it gets back just a little bit above that low, these scalpers will be able to get out with a limit order. They buy here. In case it just goes straight up, they'll make a scalp and they'll exit. And they're willing to buy more lower in case it goes a little bit lower. It might go 1 times the size of a scalp. It might go 2 times the size of the scalp. They'll buy more, betting that it'll start overlapping breakout points. It overlapped a breakout point here. Trends tend to become weaker, and therefore you get more trading range price action, and the overlap tends to become greater. They want to make at least the size of a scalp. If they buy here and buy more here, they'll place a limit order to get out break even at that low. They get out break even on this trade and with a profit on this lower entry. As I said, some bulls do not place a limit order to buy at that low and then more lower. They simply place the limit order to buy 1 point or 2 points or 3 points below that low, betting that we're now in a stairs pattern and we'll get above this low. They know that sometimes it'll just go a tick below the low and rally strongly, and they'll be flat. They won't be in the trade. But a lot of times they'll take that chance. They see that it fell a couple points below this low here. It probably will fall a couple points below the low here. And therefore, instead of buying at the low and adding on, just take the second entry down here and then scalp out with a profit. Here's an example of what I was talking about. If a bull bought with a limit order at this low, and he was willing to buy more lower, it never went lower, it immediately went up. So he did not have to scale in, he immediately got his profit. Exit with the scalp, betting that the market is probably going to be in a trading range. He doesn't know where the top of the range is, it might be simply here. However, he made his scalp and he's happy to exit and then look for his next trade. I talk more about scaling into trades above prior highs and below prior lows for scalps in several of the videos. Trading in tight bull channels, tight bear channels, broad bull channels, broad bear channels, trading ranges, and in the video on losing because of mistakes. I'm not going to talk too much about it here. Here's a 5-minute chart of the E-mini, and then a 5-minute chart of the euro versus the dollar. Some traders scalp one of them, some traders scalp both. There's a big difference between scalping in these two markets. Can you see what it is? It's a very important difference. Most scalpers use charts that are 1 minute to 15 minutes long. Most scalpers in general, most traders should not be trading on any chart that has more than 20 bars per hour. In other words, a 3-minute chart. I use 5-minute charts. In the E-mini, most days, an average bar is 6 to 10 ticks tall on a 5-minute chart. The minimum scalp in the E-mini is 1 point, and therefore the average bar is 50 to 100% bigger than the minimum scalp size. In a forex market, the euro versus the dollar 5-minute chart, most of the bars are 6 to 10 pips tall. But the smallest scalp traders should consider is 10 pips, and therefore most of the bars are smaller than the smallest scalp. E-mini, most of the bars are bigger than the smallest scalp. That is critical. Because in the E-mini, if every bar is bigger than a scalp, you can scalp on almost every bar. There are countless scalping opportunities in a chart where the bars are bigger than the smallest scalp. On the other hand, if you're scalping on a 5-minute forex chart, there are far fewer trades. A good trader can make money in any market. I want to talk a little bit about a scalper's personality. Everyone is drawn to scalping when they start out because of two things. The risk is small. When traders start out, their greatest fear is losing their account. It's their death of a dream as a trader. And therefore, they're drawn to trading styles that have smaller risk, in other words, scalping. However, to trade professionally as a scalper for year after year after year, and to do it happily and profitably, you need a whole bunch of personality factors that most traders simply do not have. But don't worry about it. You can make a lot of money as a swing trader. And most traders who make a lot of money are swing traders. This is a 5-minute chart of the E-mini. The day session has 81 bars, and an average day has about 40 1-point scalps and about 20 2-point scalps. Scalpers will enter with stop orders, limit orders at the market. They'll use wide stops. They'll scale in. An incredible number of opportunities to make money. These are all reasonable scalps. I'll talk about the basis for most of these trades at some point over the next many videos. And you can see the bears, lots of opportunity to sell. The bulls, lots of opportunity to buy. Nobody takes all of these trades, but a good scalper will take a lot of them. There are also many other scalps that I did not show. There are reasons to enter on every bar. If you look at the volume on a chart, every bar has a lot of contracts being traded. That means there's a lot of trading taking place on every bar. And a good scalper understands the forces going on. They understand what the bulls are doing. They understand what the bears are doing. And they're constantly trying to structure profitable trades. Where do I enter? Can I buy here? Can I sell here? If I buy, where's my stop? Can I scale in? Where do I get out? I said that a lot of beginners are drawn towards scalps because of the minimum profit. A lot of experienced traders are drawn to it because of the great profit potential. If you have 40 opportunities to scalp during the day, that's 40 points. And if the range is 15 points tall, you're making 40 points on a range that's 15 points tall. You're making more than twice as many points as there are in the range. Some traders can do that. Very few can, but those who can make a lot of money, and therefore they scalp. There are a few very good traders who scalp as their primary method of trading. Again, it takes a lot of experience to scalp profitably, and it also takes an unusual personality to be able to do it comfortably year after year. Trading has to be fun. If you're going to be doing this forever, it has to be fun. And just because you can make money as a scalper does not mean it's right for you. If you feel stressed out and miserable doing it, don't do it. Swing trade instead. Find a style of trading that suits your personality. You have to be happy. Life has to be fun. As I said, almost every bar has some kind of a setup for a scalp, and an extreme scalper might take 20 to 40 trades a day. Most experienced scalpers take about 10 trades a day. Some days they might take 20. If you are taking 20 to 40 trades a day, you're doing manual high-frequency trading. Again, extremely difficult to do profitably. In the E-mini, the minimum scalp size is 1 point. Great traders can scalp for 1 to 2 points all day long and win 90% of the time. I've known many traders who have done that over the years. But very few can do it long term. I had a friend who would look for swing trades every day, but he liked to scalp to show off. I traded with him online for years, and most of the days he would be going for 4-point trades, and then every now and then he'd say, "Hey Al, I'm going to scalp today." And he would take a whole bunch of 1-point trades. He'd probably take 15 or 20 1-point trades. And I remember a lot of days in which he won on every trade. But he said it was too stressful and it was not fun. He liked doing it to show off. There are fun things to do in life that you don't want to do every day. You don't want to climb the top of a tall mountain every day, but you do want to do it occasionally because it gives you a sense of accomplishment. Just because you can do something doesn't mean you should be doing it for your career. If you climb Mount Everest, you don't want to be climbing it every 2 months for the rest of your life. It's not fun. It's fun the first time, but it's not fun the 5th time or the 20th time. In this video, I talked about trading ranges as limit order markets, markets where scalpers take trades at the bottom, betting that it will go up. They buy at the bottom, they sell at the top, betting breakouts will fail, and the trading range will continue. I then talked about the personality of scalpers. Most traders do not have the personality that would allow them to scalp profitably long term. It's simply not fun for most traders. However, if you are that rare person who can scalp profitably and you enjoy doing it, then it's a good opportunity for you. Every trader, every swing trader takes scalps some of the time. Not necessarily because they plan the scalp, but a lot of swing trades end up disappointing the trader as soon as he takes the trade. He'll scalp out with a small profit. And therefore, knowing how to scalp is valuable. I'm Al Brooks. This is the first of 5 videos on scalping. Thank you for watching the Brooks Trading Course. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on scalping. I want to make the important point that beginners should avoid scalping. It's just way too easy to lose money. They have to win at a very high percentage rate, and that's impossible for a beginner to do. Some scalpers use 2 time frames. They look for the setup on 1 time frame, and then they look for an earlier entry on a smaller time frame. Why do you think beginners scalp? It's because it's the smallest risk per trade. They focus on risk. They work very hard to get an account that allows them to trade, hoping to become a profitable trader, hoping for a career change, and they want to consistently make money. They want to make a lot of money. However, they usually start with a small account, and they had to work very hard to get that account. And then there are also family pressures. Your spouse, your kids, you have to take care of them, and you have to be very protective of the money. You don't want to lose a lot of money quickly. As a result, beginners naturally focus on risk. And that's a problem because there are three variables that they have to consider: risk, reward, and probability. Whenever a trader structures a trade, he has to make sure the combination of three variables makes sense. He has to make sure that the trader's equation is positive. That means that the probability of winning times the expected reward has to be significantly greater than the probability of losing times the expected risk. But you hear in that equation three variables: probability, risk, and reward. And the problem that beginners have is they focus on risk. They should be focusing on risk-reward ratios compared to probability. These are all reasonable scalps. Every red rectangle is an entry price for a short. Every green rectangle is a reasonable scalp buy. This is the E-mini chart. Minimum scalp size 1 point. You can look at some of these bars and say, well, why would anyone ever buy this close? We have consecutive bear bars trying to break out below a trading range. And the reason why traders buy that close is the bears need one or two more bars to take control. They have not clearly broken below the range, and they do not have a follow-through bar yet. As a result, bulls buy the close, betting that the bears will fail, knowing that most trading range breakouts fail. Beginners spend too much time worrying about risk. And if you only look at one variable, you're going to ignore the other two variables, reward and probability, and you'll lose money because every trade has to have all three lined up in a way that makes sense mathematically. Beginners, they're just very afraid of losing their dream. It's the death of their dream if they lose their account. Or if the account falls to a level that is too small to meet margin requirements. That's called a blown account. Consequently, beginners only look at risk, as I said, and they ignore reward, and they especially ignore probability. An average 5-minute E-mini chart, the average bar is bigger than a minimum scalp size, 1 point. And that means there's enough room for a scalp on almost every bar. And a really experienced trader can see potential entries on every bar. That does not mean he takes every entry, but it means he sees lots of opportunities. And he only has a matter of minutes, sometimes seconds, to process risk, reward, and probability. And if he feels like he's not satisfied with his conclusion, he does not take the trade. 81 bars per day, 5-minute chart, E-mini. At least 40 reasonable 1-point scalps. Most experienced scalpers take between 10 and 20 scalps a day. These are average looking bars in this area. This is 12 ticks tall, maybe a little bit bigger than average. Here, an average height bar, 9 ticks tall. And this bar, one of the smallest bars on the screen, is still 6 ticks tall, which is 50% bigger than a minimum scalp, 4 ticks, 1 point. Even a small bar like this has opportunities for scalpers. For example, after 3 consecutive bull bars, reversal up from the bottom of a range, they'll buy the close, and they'll try to buy more at the low of the bar. They did not get filled. The market tried to get there once, tried to reverse down twice, failed twice, and reversed up. The bull scalper will then take his profit somewhere up in here. It's very difficult to win 90% of the trades unless you are willing to use wide stops and scale into your position. Even then, it's difficult to do, but most skilled scalpers are willing to scale into a position, and a lot of them will use wide stops. And by doing that, they're increasing their risk. The stop is further away. They're increasing their position size, which increases their risk as well. Their reward is fixed. They're looking for a scalp in the E-mini, 1, 2, 3 points. But what they're doing is, in exchange for accepting more risk, they're getting a much higher probability of success. Remember, probability is the flip side of risk-reward. You cannot have a great risk-reward trade with a very high probability of success. There has to be an institution willing to take the other side of your trade, and that means constantly there's always a problem with either probability or risk or reward. If you're trying to get higher probability, you have to pay for it with a worse risk-reward ratio. The institution taking the opposite side of your trade has to get something in return for giving you higher probability. When a trader scales in, he increases his risk, but he also increases the probability of making money. And that's the main reason why skilled traders often scale in. They'll use wide stops and scale in to increase their probability of success. The market's in a trading range here. On any chart, in general, 90% of the bars are either in a trading range or in a channel. When that's the case, a trader can make money buying or selling at any time as long as he manages his trade properly. For example, the market is in a tight range, reversing repeatedly in here. The bulls have a pretty good bull bar here and a second good bull bar here, trying to reverse up from the bottom of a range. It's reasonable for a trader to buy on a stop just above the high of this bar, looking for a scalp, but he has to use the stop below the bottom of the range. The market reversed up again, now has a micro double bottom in addition to this double bottom. It's reasonable to buy here if a trader can put a stop down here, just below the bottom of the range. Here's the stop. Many skilled traders will look to buy more 1 or 2 points lower, expecting that the reversal down will fail. Think about it from the perspective of a bear. Does he really want to sell below the low of this bear bar? He's selling at the bottom of a tight trading range where the market reversed up, probably going to reverse up again, especially given that this bear bar has a very big tail. It's a bad looking sell setup, and therefore it's probably a decent looking buy setup. Experienced traders know that, and if they bought on a stop above the high of this bar, they might buy more at the low of this bar, scaling into the trade. If a bull did that, he would try to exit break even if the market gets back to his original entry price, and then he'll end up with a 10-tick scalp on his second entry. He buys here, just above this bull bar, buys more at the low of this bar, which is 10 ticks lower, and then when it gets back above the high of this bar, he gets out break even on his first entry, and then with 10 ticks profit on his second buy. I want to talk a little bit about trading on 2 time frames. Some traders like to find setups on 1 time frame and then entries on a smaller time frame, hoping to get in as early as possible, thereby reducing risk. For example, some traders will look at a 60-minute chart, and then when they think they have a setup, they'll look at a 5-minute chart to see if they can enter with smaller risk. Likewise, a trader looking for patterns on a 5-minute chart might try to enter on a smaller chart, like a 3-minute chart, a 2-minute chart, or a 1-minute chart. In general, most skilled traders trading on the 5-minute chart will rarely ever use a 1-minute chart for entries, maybe 10% of the time or less. I talked about this buy setup, where traders buy that high, scale in more, and exit. But I also said that a trader could sell there as well, and if he manages his trade correctly, he would make money. It's a tight trading range, and therefore if a trader sells and sells more higher using a wide stop, he probably will make money. Let's say he places a limit order to sell at the high of that bar. He'll get filled here. It fell more than 2 points. He could have scalped out. Let's say for some reason he did not exit. Let's say maybe he was hoping for a swing down, and then we got the reversal here. He then would conclude that instead of a swing down, it's in a trading range, and he's going to switch to scalping mode. No matter what he's doing, if he's taking this short, his stop belongs above the top of the most recent sell-off, strong sell-off, 3 consecutive bear bars, 2 of them pretty big. And then he gets disappointed by this reversal up. He might decide that instead of a swing down, it's going to stay in a tight trading range instead. He'll then look to scale into his shorts, for example, sell at the prior high using that original stop. So he sells here at the high of this bar and then sells more at this high as long as it's at least the size of a scalp higher. In this particular case, it's 8 ticks higher, so it's 2 points higher, and that's twice as big as the minimum scalp. 8 ticks is 2 points. When the market comes back to his original entry price, he can exit break even at his first sell and then with a 2-point profit on the second sell. Remember my 90% rule. 90% of the bars on a chart are in trading ranges or channels, and a skilled trader can make money buying or selling if he manages his trade correctly, which usually means scaling in and using a wide stop. Here's a 5-minute chart and a 1-minute chart. This blue area is right here. This is the entire blue area right there. This is the 1-minute chart. A lot of traders will look for a trend on one time frame and then look for an entry on a smaller time frame, hoping to get in earlier, reduce risk. For example, we have 2 legs down, 1 pullback 2, arguably 3 pushes down, 1 and then up, and then 2 and then up, and then 3 and then up. It's reasonable to buy this. It's about a 50% pullback. We have a spike pullback channel. It's a pullback to a slightly higher low. We had about 7 or 8 bars up without a bear body, and we're pulling back to the moving average. Plus, there's a very good looking bull bar. It's reasonable to buy on a stop just above the high of this bar, and you get filled right here, 1 tick above the high of that bar, looking for trend resumption up. Most traders look at this as a pullback and not the start of a bear trend. And a pullback means you expect trend resumption up. You expect it to become a bull flag. And therefore, some traders will look for as early an entry as they possibly can get. For example, if a trader, instead of placing an entry based on the 5-minute chart, zoomed in and looked at the 1-minute chart, this area here is this area here. He'd see a spike, pullback, second push, pullback, third push, and then a reversal attempt. He would buy above the high of that 1-minute bar, and he'd get filled somewhere down here instead of up here. This is the entry on the 5-minute chart. That green box is right here. And a trader using the 1-minute chart would enter 5 ticks lower. And the same is true with higher time frame charts as well. Some bull scalpers will look at 15 or 60-minute charts for setups. They look for support and resistance, and then enter on a 1-minute chart or a 5-minute chart. In general, I think traders should not be entering on a 1-minute chart. I think it's perfectly reasonable to look for a pattern, a test of support or resistance on a 60-minute chart, and then entering on a 5-minute chart. I think it's much harder to be trading on a 5-minute chart, looking for patterns on the 5-minute chart, and then entering on the 1-minute chart. You don't have much time to make decisions, and you'll make too many mistakes, and you'll find yourself only looking at the 1-minute chart and not paying enough attention to the 5-minute chart. Therefore, most traders should not be doing this with a 1-minute chart, except in rare circumstances. Remember, the trader on the 1-minute chart is trying to reduce his risk. If he buys above the high of this bar, he gets filled here, his stop is a little bit below. If he buys on the 5-minute chart, his entry is here and his stop is further below. Whenever you do something to improve your risk-reward ratio, you pay for it with reduced probability. And the 1-minute chart, it's a less reliable chart. The probability of trading it well and the probability of setups working is lower. For example, here, if you buy above the high of this bar on the 1-minute chart, you're buying after 5 bars without a bull body. And 3 of the bars are bear bars, 2 closing on their lows. This is not a strong buy setup on the 1-minute chart, even though it's a wedge. 1, 2, 3, or 1, 2, 3. This is not a high probability buy. Another problem is time. On a 1-minute chart, you can have a great looking setup become a very bad looking setup in a second, or less than a second. Or the opposite can happen. You can have a terrible looking setup become a very great setup in a second or less before you have time to act on it. Also, if you're trading really well, if you're a good trader, you're not going to make significantly more money by going down to a 1 or 2-minute chart. If you're trading well, you can make a lot of money on the 5-minute chart. Very often, at the very final second or two of a chart, a 1-minute chart, for example, the institutions can quickly create a tail, a reversal, or erase a tail. You had a reversal and then it becomes a trend bar in the final second of the bar. For example, look at this bar. It's a strong bear bar closing on its low. We don't know for a fact but it might have been a bull bar with a one-tick bull body and a big tail below until the final half second, and then it did that in the final half second. And that does not give you much time to think about what to do next. And if you're a beginner, you're not accustomed to thinking of the exact opposite within a second. You're looking to buy and all of a sudden it becomes a sell, or you're looking to sell and all of a sudden it becomes a buy. And you end up making decisions without giving the decision enough thought. You end up making too many bad decisions and you lose money. There's just not enough time for most traders to make good decisions. And then physically to place orders. You have to place your order, you got to place a stop, you got to place a bracket order, you got to make sure you do it correctly, and there's just not enough time. Another common problem with 1-minute charts is you quickly decide that you're going to buy or you're quickly going to sell, and you're so eager to get in just for that instant that you enter at the market and the order gets filled 1 or 2 ticks above or below where you wanted it to get filled. And that means that if you think the profit target was based upon your original entry price and you get filled a tick or two worse, all of a sudden you're getting less reward and increased risk. The math becomes bad. Whenever the math is bad, institutions are going to take your money. You're going to lose money. One guideline that I use is traders should not be trading on any chart that has more than 20 bars per hour. So for example, if you're trading on a time chart, that's a 3-minute chart. A 3-minute chart has 20 bars per hour. So I think most traders should not be trading charts less than 3 minutes, 3-minute charts. And then the same is true if you're trading on charts based upon ticks or volume. I think you should not be trading any chart where you have more than 20 bars per hour. Very often, at the beginning of the day, let's say you're trading the E-mini and you're using a chart that has 5,000 ticks per bar. Early in the day, 5,000 ticks per bar might be 30 or 40 bars per hour. And I think that is too many bars, and I think you should not be trading that. Later in the day, from maybe 9 o'clock to 10 o'clock or 11 o'clock, 5,000 ticks per bar could be fine. You may only get 10 bars per hour. And that's another problem with using charts that are based upon ticks or volume. The number of bars per hour fluctuates a lot, and I personally like to be thinking about time. I think all the time about time. And I don't like the bars having a different time before they close. If using a tick or volume chart, sometimes a bar will last a matter of seconds, other times it'll last 10 or 15 minutes. I like to know when a bar is about to close. When you look at the chart, this 1-minute chart of the E-mini, it looks easy, but you often end up buying early above bad signals. For example, you might buy above here for high 2, and then you argue, oh, it's a wedge, 3 pushes 1, 2, 3, and you quickly buy there, and you use too tight a stop, you get stopped out here, instead of using a wider stop and looking to scale in lower. A lot of setups just don't look good enough, and you have very little time to make up your mind, and a lot of times you'll take the trade and not use a wide enough stop, and you get stopped out, and then the trade goes your way. That's another common problem with 1-minute charts. You can end up losing money buying in a bull trend. For example, let's say you buy above the high of this bar, and then you got a bear bar closing on its low, another bear bar closing on its low, 3 consecutive bear bars, you may end up exiting, and it turned out to be a bull trend. And the same with here. You can end up losing money selling in a bear trend. You sell below a low 2 here, and then you get a reversal and you exit here, or you exit here above your entry price. Beginners have very little time to decide, and they see a wedge. 1, 2, 3. I gotta buy. There's a small II. Maybe it's an II, small final flag, triangle, up, down, up. And maybe we'll go up a wedge with a triangle final flag. Maybe I'll buy above that bar. It's just really too easy to make bad decisions, and you end up taking trades where the probability is too low, and you do not use a wide enough stop that would allow you to increase your probability, especially if you're able to scale in. Let's say you buy it on a stop above this bar, you get stopped out below its low, you end up losing 5 or 6 ticks on that, even though the market ended up going up. Would an expert trader take this buy, arguing wedge 1, 2, 3? Probably not. But again, even an expert trader does not have much time to make the decision. He would be ready to buy, but he would like to be buying above a bull bar, or he'd like to be buying at the close of a big bull bar, or in the follow through after a big bull bar. If he did buy this, he would probably use a 4 or a 5 point stop and look to scale in lower. Instead of getting stopped out below the signal bar, he might buy more below the signal bar or at the low of the signal bar using a 3 or 4 point stop, betting that the bear breakout would fail. If he's looking to buy on the 5-minute chart and he sees this as a probable bull flag, a bear leg and what will become a bull flag, he's going to be willing to use a wider stop. Again, as you can tell, I'm recommending not using a 1-minute chart. An experienced trader who does look for the early entry in the 1-minute chart will use a wider stop, 4 points, 5 points, maybe 6 points, depending on the size of the day's range, and he probably would be willing to scale in lower. How far a stop? Well, we have a reasonably good bear breakout here, so maybe use a stop just below the measured move down. Here's the measured move down. Maybe put a stop just below that. It might be 2 or 3 points down below the original entry. I made the important point that beginners should avoid scalping because it's just too easy to lose. They'll focus only on risk and they'll ignore probability and reward. They'll especially ignore probability. And whenever you trade, you have to consider risk, reward, and probability. If you only look at one of the variables, you are going to lose money. And then finally, traders sometimes like to use 2 time frames. They look for a setup on 1 time frame and then an earlier entry on a smaller time frame. While it sounds good, for example, trading on the 5-minute chart, looking for an early entry on the 1-minute chart, I think most traders who do that will rarely do it, and it rarely ever significantly improves their profitability. If a good bull scalper takes 10 or 15 trades a day, he might do that once a day, and the rest of the time he'll simply rely on a 5-minute chart. He might dial down to a 2 or 3-minute chart occasionally, but he's going to base most of his trades on the 5-minute chart. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on scalping. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on scalping. I want to begin by talking about ticks and how traders can use them to find scalps. And then I want to move on to tick divergences, which is a particular way to use ticks to find scalps. I have a 1-minute chart of the E-mini, and I have the tick chart down below, a 1-minute chart of the ticks. The red line is minus 1,000, the top red line is plus 1,000, and then the blue lines are plus 700 and minus 700. The New York Stock Exchange has about 3,000 stocks on the exchange. If the current trade of a stock is above the last trade, that adds plus 1 to the ticks. If the current trade is the same as the last trade, it adds 0 to the ticks. If the stock is now trading below its last trade, it adds minus 1 to the ticks. The current tick value on the chart below is the sum of all the ticks for the 3,000 or so stocks. If the ticks equal 1,000, here slightly above 1,000, then 1,000 more stocks went up than down on the last trade. For example, let's say right here, at that instant, 600 stocks were unchanged. Their last trade was the same as the trade before. And 2,200 stocks went up. The current trade is above the prior trade. And 1,200 stocks traded below their last price. Then the value of the ticks is 0 plus 2,200 minus 1,200, and you get a 1,000 tick reading. And the opposite took place down here, where you get a minus 1,000 tick reading. You can see the low of that bar was minus 1,009. That means there were 1,009 more stocks on the New York Stock Exchange that went down on their last trade compared to those that went up. The high of this bar on the tick chart is 1,052. Therefore, the difference between the number of stocks that went up on their last trade compared to the number of stocks that went down on the last trade was 1,052. That means most stocks are going up. And it makes sense that if most stocks are going up, then the indices would go up. And the E-mini is the futures contract based upon the S&P 500 contract. Not the New York Stock Exchange, but a very high degree of correlation. If the E-mini is sideways to up and then has a bear breakout, traders look for the first reading below minus 700 or even below 1,000 as a sign that the momentum down is strong. Most stocks are going down. When that's the case, usually the first reversal up will fail and the market will go at least a little bit lower. Very strong bear breakout. Even without looking at the ticks, you know the odds are high the first reversal up will fail and lead to a new low. Traders who watch the ticks, when they see a new bear breakout and a tick reading below 1,000, some of them will sell instantly at the market, thinking that the market will go at least a little bit lower. It's a reasonable scalp trade. They might sell the close of the next bar. They might sell at the market as soon as the tick reading hit minus 1,000. They might sell above a reversal bar, betting that the first reversal up will fail, and you'll have to have a higher low in ticks and a lower low in price before there's much chance of a bounce. In the E-mini, it's a high probability trade for a 1-point scalp. If a trader sold that close and scaled in, sold more 1 point higher, his stop would be all the way up here. He's never going to let that stop get hit. He would exit long before then. However, he would sell the close, sell more higher, and then possibly look to get out break even on his first entry, and then with a 1-point scalp on his second entry. Or he could exit at the low, thinking that the odds were high. The low in ticks will not be the low in price. Price will go down a little bit more. Here, ticks fell almost to the blue line, minus 700, but we're getting near the end of the day. Remember, this is a 1-minute chart, and you can see it's already 12:50 Pacific time, so there's not much trading left of the day. And therefore, selling with limit orders on a rally is a risky thing to do. When the bears see this very strong reading in ticks during an initial bear breakout, the start of a possible bear trend, they'll sell for any reason. They'll sell the close of the bar that hit minus 1,000. They'll sell a reversal up. Here we got a small double top bear flag, this high and then that high. So low 1, low 2, sell that for a scalp. We have a strong rally up, but again, it's a 1-minute chart. First pullback to the moving average. Traders will look to sell. After 6 bull bars, they might take the second entry down, which would be to sell below this bear bar closing on its low. Again, this is a 1-minute chart, and most traders should not be trading the 1-minute chart. However, these are the kinds of things that scalpers will do when they see a dramatic drop in ticks or a dramatic rally in ticks. They'll do the opposite up here, expecting the high in ticks will not be the final high in price. Remember, these are scalps, so traders are looking to exit with a 1-point profit. The range here, while it looks big, is really not all that big. This is a 1-minute chart, and this is about a 6-point range, and therefore scalping for 1 point is reasonable. If the market is sideways to down, but then has a bull breakout, traders look for the first tick reading above 700, the blue line, or above 1,000. And once they see it, they expect the market to go a little bit higher. Here, you can see we touched the blue line, 700 in ticks, and we're in a bear trend. We're getting a pretty good reversal. Again, 1-minute chart, it's a scalp. A lot of traders will buy at the market, or they'll buy a 1-point pullback on the first touch of plus 700 on a reversal up, expecting that the market will go at least high enough up for a scalp. Let's say you buy the close of that bar when it first hit our tick reading of 700. You can buy more lower, betting that the odds are high you'll be able to make a profit. So for example, you buy a 1-point pullback from the first entry, and then you get out break even on your first entry, and then with a 1-point scalp on your second entry. You can buy for any reason. You can buy at the close of the bar that hit 1,000. You can buy below its low, a bull bar, a bad sell. You can buy 1 point down. You can buy at a pullback to the 1 minute moving average. Your risk is at least below here, so you're risking 3 or 4 points to make a 1 point scalp. If you manage the trade properly and are willing to scale in and are quick to decide that the trade is bad, it's a profitable strategy. There were many ifs in that sentence. Some traders will exit with a 1 point scalp, wherever they bought, below bars, above bars. Very strong bull breakout. Ticks hit 1,000. They went above 1,000. And therefore, a new high in ticks and a new extreme in ticks, very bullish. Most stocks are going up. Traders will buy at the market. They'll buy a reversal down. They'll buy a resumption up, betting that the final price will be above the price when ticks hit 1,000. Usually the high in ticks does not correspond to the final high in price. Usually price goes higher after you get an extreme reading of ticks early in a trend. Traders will therefore bet the first reversal down will fail. They'll buy below the bull bar. They'll buy above the high one. We have a little pullback. They'll look to buy at the moving average. They'll buy the breakout of this small bull flag, bull breakout, small pullback, it's a bull flag. And then look to take profits about a point higher. If they buy up here, their stop is probably going to be below the bottom of this very strong bull breakout. It should not fall below here if, in fact, the trade is good. First pullback to the moving average, a double bottom bull flag, a breakout. Again, this is a 1 minute chart, and most traders should not be doing this. However, scalpers, experienced scalpers, do trade like this. They look for all kinds of little tricks on the tick chart to help them find trades on the E-mini chart. Now, here again, we're hitting 1,000 in ticks, the first time during a rally that has gone on for 30, 40, 50 bars. And look at the rally. It's a stair-step pattern. We have a breakout, a pullback below the breakout, a new high, and a pullback below the breakout. A new high, we're probably going to pull back below the breakout. And we're also probably near the potential top of a trading range. This looks like a bull leg in a trading range. When that's the case, when you get an extreme reading in ticks occurring late in a trend, you have to be careful that it might be an exhaustive end of the trend and not the start of an even stronger part of the trend. And again, subjective, but in general, if you're looking to buy ticks, you want to buy them early in a trend, not late in a trend. Late in the trend, it's more likely to be a climactic end of the trend than the start of an even stronger leg up. We're stair-stepping up. We go above this high, we pull back. Above this high, we pull back. Above this double top, we pull back. Well, what do you think is going to happen when we get above this high and this high? We're probably going to pull back. With this many stairs, chances are the market's going to enter a trading range fairly soon, or possibly even a bear trend. And therefore, buying a new high reading in ticks is a low probability bet. A possible blow off in ticks, possible blow off in the stock market. Traders will wait to see if the bears get stronger. For example, like a very tight bear channel, in which case they'll stop looking to buy. You want high tick readings early in a reversal or early in a trend. Those have a high probability of follow-through trading. Again, we have a 1 minute E-mini chart, a 1 minute tick chart. And look at this. The ticks hit about minus 1,000. I don't know if it's quite there, but very close to it on this bar. It's also a fourth new low in ticks. Ticks made a new low here, a new low here, new low here, new low here. This is a possible climactic end of the trend. Usually the low value in ticks is not the final low value in price. Here we have ticks almost to 1,000, minus 1,000, and here's the price. Usually that will not be the end of the trend. Usually you'll get at least a little bit lower price and a higher value in ticks. You get some kind of divergence, a tick divergence, and it leads to at least a bounce. Again, a low tick reading, minus 1,000, late in a trend, especially a trend that's stair-stepping down either in price or in ticks, there's a higher chance that it is a climactic end of the trend rather than an acceleration into an even stronger trend. I mentioned tick divergences a moment ago. I'm going to talk a little bit more about that now. Stock market is rallying, E-mini 1 minute chart. We have a new high in price, but look at this. Ticks hit 1,000 over here, and we have a new high in price and a lower high in ticks. Therefore, fewer stocks are going up compared to the number of stocks that went up over here, yet the price is going higher. And then here, we have a strong breakout to a new high, and look at ticks. We have fewer stocks trading above their last trade at this higher high in price than what we had over here. This is a tick divergence, and it increases the chances that the bull trend will either turn into a bear trend or a trading range very soon. The high in ticks, when the first time you hit 1,000, usually not the end of the move. We went up a little bit more, and then we went up more again 30 bars later. Bulls will buy the first high in ticks, which will be over here, or they'll buy the reversal down, betting that the first reversal down will fail. The traders who did buy this breakout, some of them will buy more lower. If they bought this, they might buy more lower as well. They always want the second entry to be at least as big as a scalp below their first entry, and then they look to get out at their first entry. For example, if you bought that high close and you bought more down here, this entry, you want it to be at least a point below that, so that when it gets back to that high close, you get out with a 1-point scalp here, and you can get out break even here. The E-mini sold off at this price. It pulled back at around that price again, and it might pull back when it's up at that price a third time. And we're getting a tick divergence. You can see at this price, we have ticks here, and the ticks here later are lower. So we have a tick divergence from this high to that high, ticks getting lower, and we have a tick divergence from this high to that high. So ticks getting lower. That increases the chances that this is near the end of the move and that the rally might soon be converting into either a trading range or a bear trend. I had a friend years ago, I traded with him for a year or two in a chat room, and this is what he did all day long. He would simply look at a 1 minute chart of the E-mini versus ticks and look for 1 or 2 tick divergences a day, and he was trading 25 contracts looking for a 1-point scalp. I have no idea whether or not he was profitable. However, the way he talked made me believe that he was profitable, that he was picking the right trades to fade. We have a bull trend on the 1 minute chart, and it's pretty strong right here. Therefore, only experts should ever consider selling a tick divergence in a reasonably strong bull trend. It's just too easy to make mistakes. And remember, this is a 1 minute chart, and most traders should not be trading the 1 minute chart. However, as I said, experienced traders are looking for scalps, and some of them do trade 1 minute tick divergences and 1 minute tick extremes. Ticks are going down over here. Traders will expect that this bear reversal, 20 bars or so, is probably enough so that we're converting into a trading range. This looks like trading range price action. This looks like trading range price action. And traders, therefore, will look to sell at a prior high, especially when the ticks are at a lower high. They'll sell either with a limit order at that prior high or on a reversal down. Here we have an IOI and a bear bar closing on its low. Some traders will sell on a stop below that bear bar and then try to exit 1 or 2 points down. Tick divergence, here we got a very strong sell climax, and the low in ticks is about minus 1,000. That's probably not going to be the low in price. However, if we make a low in price and ticks do not make a new low, that increases the chances that we'll get a reversal at least into a trading range. The first time down, ticks to minus 1,000 in a new bear breakout, traders will sell for any reason. They'll sell bear closes, they'll sell above bars, they'll sell reversals down. looking for at least a scalp, expecting the E-mini to make at least one more new low. And then they try to exit at the prior low or with a 1-point scalp. If the E-mini is at a confluence of support, for example, you don't see the bars to the left here, but if this is the 5-minute moving average and a wedge bottom on the 5-minute chart, a 50% pullback of a rally, if there are many things going on here that increase the probability that bulls will come in, if you then also see a tick divergence, this could be the end of the pullback, and it could lead to a resumption of the rally that you see on the higher time frame chart. When that happens, bulls will start buying at prior lows in price, expecting that the tick divergence will lead to at least a bounce and possibly a resumption of the bull trend on the higher time frame chart. Again, you have a very strong bear breakout, buying in a very strong bear trend based upon anything. A tick divergence is a very difficult way to make a living. Only expert traders should consider doing this. There are many decisions that a trader has to make when trading a 1-minute chart in a tick divergence. Most beginners cannot make the decisions accurately, fast enough in the time that they have on a 1-minute chart, and therefore it's a dangerous strategy. If an expert trader did buy the reversal up, he could scalp, get out with a 1-point scalp, or he could hold for a swing trade, especially if this is at a support area on a higher time frame chart like the 5-minute chart. Here the market's in a bear trend. Some traders will watch tick rallies when the E-mini is in a bear trend, expecting the tick rallies to correspond to a bear flag on the 1-minute chart, and therefore they'll look to sell. For example, strong bull close above 0 in ticks probably is not going to lead to a tick reversal if the ticks have been mostly negative. Sometimes they'll sell with limit orders at prior highs in ticks. We have ticks going above this high, and as soon as that happens, an E-mini trader might sell at the market, looking for at least a little bit lower in price. Again, a new high in ticks, but in a bear trend. So as soon as it happens, some traders might sell at the market, expecting that they'll be able to make at least a scalp. Ticks going above the prior high in ticks, traders sell at the market, looking for a scalp down. This high in ticks is above that high in ticks, and traders will therefore look to sell at the market when this bar goes above the high of that tick bar, looking for at least a 1-point scalp. We have a wedge in price, 1, 2, 3, a wedge bottom, and ticks are making a higher low. We're getting a tick divergence. A new low in price, a higher low in ticks, often leads to a transition into a trading range. And then look what's taking place over here. The market's sideways in a bear trend. After about 20 or 30 bars, the probability of trend reversal up is about the same as trend resumption down. But take a look at what took place here. Most of the ticks are above 0. That increases the chances that we'll get a bull breakout. In any case, because the market's in a trading range, bulls will look to buy whenever the ticks get near prior lows or slightly below prior lows. Here you can see we're right at that low and we got a little bounce. Bulls might buy here, risk 2 or 3 points and try to get a 1-point scalp. Again, ticks are at this prior low. Bulls will look to buy. Now we're starting to get a bull breakout and we're getting a big bear bar. Again, ticks are at the prior low in ticks. Every time the market has been here, the selling has stopped. We're getting a little bit of a bounce. Bulls will buy this little tail at the prior low in ticks because every time the market gets to this tick level, we've been getting a bounce in ticks and usually corresponds to a bounce in price. It can be the start of a swing, but I'm talking about scalps, and most traders taking that kind of a trade will scalp. I mentioned that we had a bear trend. We were sideways for about 30 bars, maybe 40 bars. But look at ticks during that time. ticks are mostly above zero, yet price is below the moving average, and we're in a bear trend. That increases the chances that we're going to get a bull breakout. Also, we have several tick readings around 700. We have no tick readings around minus 700. So ticks are getting bullish and price is neutral. That increases the chances that we'll get a bull breakout. I talked about using ticks to find different scalps when trading, using a 1-minute chart of ticks and the E-mini. Some traders use a 5-minute chart of the E-mini and a 5-minute chart of ticks, and they can see the same signals, same types of signals. And then I also talked in particular about tick divergences. If you're getting a new low in price, but a higher low in ticks, and you're in a bear trend, that bear trend is weakening, and it may soon convert into a trading range, and traders therefore will be more willing to buy for a scalp. Likewise, if the market's rallying and we have a new high in price, but a lower high in ticks, the trend is weakening, fewer stocks are participating, and it increases the chances that the bull trend will soon evolve into a trading range, and therefore traders are more willing to sell for scalps. This is Al Brooks. This is the third of 5 videos on scalping. Thank you for watching the Brooks Trading Course. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 5 videos on scalping. I'm going to be giving some very specific scalping examples in this video, and I'll talk about how to manage the trades. The E-mini opened here with a big bear bar. Yesterday was a tight trading range, but we have a second consecutive bear bar. And for me, the market, therefore, is always in short, meaning that the first reversal up probably will be sold. I'm going to be talking about a lot of scalps in this video, and most traders can sometimes spot scalps in time to take them, but if it distracts them from taking swing trades, they should stick to the swing trades. However, if they are able to take the trades and manage them well, then go ahead, take them. I use the image of a little man holding out his arm with a little bag of money in it. As long as I'm able to grab all those little bags of money, they can add up to a big bag of money by the end of the day. A lot of times you'll realize that a scalp is setting up too late to take the trade, a few seconds late. And since every tick matters in a scalp, if you're late, it's better not to take the trade. But don't worry about it, because most of your money will come from swing trading. Also, if you want to scalp, there'll be plenty of other scalps. On a typical day, there are at least 40 one-point scalps. Again, if you spot it in time and you think you can manage it appropriately, go ahead and take it. Yesterday was a tight trading range, and we opened here with a big bear bar, and we have consecutive bear bars. The day is always in short. A lot of traders will place a limit order to sell at the high of this bar and look for a one-point scalp. We have a tight trading range at the end of yesterday, and we are reversing up a first time and a second time here. So it's a second entry buy at the bottom of a tight trading range. It's reasonable to buy looking for at least a bounce. This is a possible low of the day. It's a micro double bottom. The market went down on this bar and went up on this bar, and went down on that bar, and now it's going up a second time. So a second failed breakout of the bottom of that tight trading range. And we have a bull bar. Not a great looking bull bar, but it's a bull bar, and it's a second entry buy at the bottom of a trading range. The odds are it'll go up at least enough for a scalp. So traders will place a stop order to buy one tick above the high of that bull bar, and they'll get filled here, and they'll put their stop just below. And they place a limit order to exit with a 1-point profit right there. Their reward is smaller than their risk. And that means you have to be very good at determining probability. Probability has to be far greater than 60% to trade this. In this case, the probability might be 70 or 80% that you're going to make a profit. How do you know that? From experience. And that's one of the difficult things about scalping. The initial risk is often greater than your planned reward, and you need a very high probability to be profitable. The actual risk here, if you buy one tick above the high of this bar, your actual risk is one tick below. So you're risking about 6 ticks to make 4 ticks. And therefore, if you're right 70% of the time, you'll make money. The bears get a reversal down. Now we have a very big outside up bar, but we're near the top of yesterday's tight trading range, and we've had many reversals already today, up and down and up, and then down and then up. This is a trading range market. If you think about this for a moment, let's say you want to buy above the high of this bar. You're buying toward the high of a tight trading range, and the reversal up is not all that strong. We have a good bull bar, but you're buying fairly high up in a range. Is the probability high for that? No, it's not. And look at the size of the bar. If you buy above the high of this bar, your stop is below the low of the bar. Your risk is great. So here you're thinking about buying above the high of this bar, risking a lot, with a low probability bet buying at the top of the trading range. Therefore, in fact, there probably are more sellers above the high of this bar than buyers. So, should you be buying up here or should you be selling up here? You have a big bull outside up bar, but a trading range market. Traders who are buying this bear close and this bear close and making money, if they bought this bear close and scaled in lower, or if they bought this bear close, they made money. The market reversed. If they sold this bull close, even though it's consecutive bull closes, they made money. Well, what's going to happen now? You have another big bull bar closing on its high near the top of the range. Probably it's not going to go up very far, and there might be more sellers on the close of that bar and above its high than buyers. And therefore, an aggressive scalper will sell that close and put a stop up here above the top of those three bear bars. That is really not a great short, and most traders should not take that trade. However, it did fall a point, and the bears made their money. The bears who took this short probably would have been willing to scale in higher. Tight trading range so far on the day. For the bears, they have a reversal down and a pullback, and this is therefore a low one bear flag. But look where you are. You're at the bottom of a tight trading range that has lasted about 30 bars. And look at your sell signal bar. It has a big tail on the bottom. And what happened at this price level today? We went up. We went up again. We went up. We went up. This time, do you think it's going down? No, especially with a bad sell signal bar like that. Therefore, there are probably more buyers at the low of this bar than sellers, and a bull scalper will place a limit order to buy at that low. He'll get filled here. He might put a stop below the bottom of this big bull bar, because if the bulls are good enough for a scalp, they should not allow it to fall below the low of this bull bar. You place a limit order to get out with a 1-point profit, and you get filled right there. Bulls starting to get a breakout here. You can call it a small double bottom high or low. This is the second reasonable attempt to reverse up from below that trading range. We reverse up here. Here's a reversal attempt, a second reversal attempt. The bears tried to make the reversal attempt fail. Look what they were met with, a bull bar. And they tried to get a small bear flag, buyers below. Now we have a small double bottom, up and up, both bars closing near their high. We have the magnet of the top of this big bull bar. Bulls want to see what's there. The bears want to see what's there. And therefore, it's reasonable to buy above the high of this bull bar. We have a pair of good bull bars closing on their highs. We have a bull bar here closing on its high. We have a bull bar here closing near its high. And we have a double bottom high or low. It's above this low. It's reasonable to buy for a scalp right above the high of that bar. If the bulls are good, it should not fall below the double bottom. You can put your stop below the low of this bar or below the low of this bull bar. You place a limit order to get out with a 1-point scalp, and you get filled there. What happens up here? Should you buy with a stop at the high of this bar, betting that we'll get a breakout and a measured move up? You can call it a double bottom with this low or that low. You can call it simply a very good-looking bull bar. I think the bulls need more to convince traders that they have taken control and that this is not now a double top. We have a small double bottom here. Maybe this is a double top. Maybe we break below here and go for a measured move down. Bulls need follow through. And until they get follow through, bears will bet the bulls will not get follow through, and therefore, whenever the bulls need one more bar, the bears will sell, betting that the bulls will not get that one more bar. For example, we have consecutive bull bars. The bulls are hoping that they get one more bar so that everyone believes they have taken control. Well, guess what? The bears are going to sell that close, thinking that, bulls made money buying bear closes today. Bears have been making money selling bull closes today. Well, I'm going to sell this bull close, betting that the bulls will not get their one more bar. They sell that close and stop above the top of the initial sell-off. Scalp out with 1 point profit. As soon as they get filled on their short at that close, they place a limit order to buy back the shorts with a 1 point profit, and they get filled right there. For the bears, they have a reversal down. If you want, you can think of it as a double top bear flag. Whenever you have a double top, I always think of it as a low 2. Here's a low 1, here's a low 2. But a fairly prominent tail, middle of a tight trading range, not a great short. However, we're still always in short. We had those consecutive big bear bars making the day always in short, and the reversal up, reversal up, reversal up, reversal up. None of it has been enough to change it. So the market still is always in short. An aggressive bear will place a stop order to sell below the low of that bar, taking a chance that we break below the neckline. Any of these bars is the neckline of this double top, and start a swing down. I don't think this is a particularly great short, but it's a reasonable scalp, taking a chance that we'll test down. And the bears exit with a 1 point profit. The bulls have another double bottom higher low attempt, but we now have 3 consecutive bear bars, and now we have a 4th bear bar breaking below the low of that double bottom. Because of the 3 consecutive bear bars, even with the double bottom, some bears will place a limit order to sell at the high of this bar, arguing, okay, the bulls are thinking they have a double bottom, but we have 3 bear bars and we have a bear body on this bar. It's a low probability buy, therefore they'll sell this high and get filled right here as it went above the high of that bar. And a lot of these bears would sell more higher. They get out with a 1 point profit. For the bulls, we have a double bottom, this low and that low, and we're trying to reverse up. It's a small high 2, high 1, and then high 2, but we're starting to get a fairly tight bear channel. You can buy with a stop above the high of this bull bar, but with 4 consecutive bear bars, I would not take the buy. I would wait. The character of the day is changing. We had 3 bear bars here. We only had 2 bull bars and 2 bull bars here. Now we're starting to get a series of bear bars. The bears might be gaining control. I'm not opposed to taking that buy. If you did take it, you get out on a stop below the low of the double bottom right here with a loss. Some traders instead would bet that the high 2 will fail. In general, I don't like to sell near the bottom of a tight trading range. Even though we have 4 consecutive bear bars, it's a second entry buy, it's a double bottom. I personally would rarely ever take that sell, even though it's a fairly tight bear channel. The logic behind taking it is we're in breakout mode. The market is probably forming either the high or low of the day. We are still always in short. The bulls never did enough to make it always in long, and the bears have a double top, lower high, and now 4 bear bars. Slightly more negative than positive. Traders will take that short, certainly for a swing down. Aggressive traders would take it for a scalp. Again, for me, that's one I would not take for a scalp. By going outside down, we have a failed high 2 buy. High 1, high 2. The bulls would put their stop down here, and we broke below the bottom of that high 2 bull flag. We might get a measured move down. We're also breaking below a double bottom here, and we're in breakout mode. This could be the start of a bear trend. You have trapped bulls who all morning long have been betting on an early low of the day. Now we're breaking below the low of this big bull reversal bar and this double bottom. Some bears will sell on a stop on the break below that double bottom. Others will sell the close of the bar, taking a chance that we're beginning a series of bear bars and that the bulls will give up. In general, by the end of the first hour and a half or so, there's a 90% chance the market has seen either the high or low of the day. And at this point, we're in breakout mode and we're breaking out below this double bottom. Probably this is the high of the day, and therefore the range will probably double, and selling this close is reasonable, certainly for a swing. Some traders might scalp all or part. If they scalp, they'll place a limit order to get out 1 point below their entry, and they get filled here. Now we have a bear breakout to a new low, a close below the low of the first 15 or 20 bars of the day. And now we have a second consecutive bear bar. Even though it has a fairly big tail, meaning this is probably not going to be a very strong bear trend, it's still a follow-through bar after a bear breakout on a day that is in breakout mode. Therefore, the odds are we'll go lower, maybe at least a couple legs, one pullback, two. Traders will look to sell. Some traders will just sell closes. If you sell the close, your stop is above the top of the bear leg. You can sell the close and hold for a swing, or you can take repeated sells, sell the close, scalp, sell the close, scalp. If you sell that close, you can place a limit order to get out 1 point lower right here. But now you have another bear bar closing below its midpoint. It's another sell the close bar. We have a sell the close bear trend. After you exit at that blue box, you sell the next bear close right here. If you sold that close and then you saw this, what are you thinking? It reversed up before you made your 1 point profit. This is a disappointment bar. If you have a sell the close bear trend and then a pretty good bull bar, the bears will be disappointed. Is it a major reversal? No, it's probably a minor reversal. The channel down is very tight. It's reasonable to sell that close. If you do something reasonable and you manage your trade correctly, you're usually able to at least avoid a loss and usually make a profit. In a sell the close bear trend like this, and the market immediately reverses up in a bull bar like that, usually you can sell more higher, like a couple points higher, expecting the market to come back down to this close. And then you can get out break even on this entry and with a profit on your higher entry. You can see what happened here. The bears who sold 2 points above this close got filled here, and then the market came back down to their close. They can get out break even at their first entry and with 2 points profit on their second entry. You can also sell below the low of this bar for a low one bear flag. We broke to a new low of the day, 3 consecutive bear bars, and we have a bear bar closing on its low. If you took the short on this close and sold more 2 points higher, you get out here with 2 points profit there and break even here. Other bears would simply sell more below a bear bar. Usually, if I take a short here, sell the close, I'm going to be selling more with a limit order because this low one short, the entry is usually not far enough above the first entry to make it worthwhile. If ever I'm scaling into a bear trend and I'm looking to take the second entry with a stop, I prefer to have my stop entry be at least 2 to 3 times the size of a scalp above my first. In other words, 2 to 3 points above the first, and this is too close to the first. Had I shorted this and did not sell more here, I would not have sold more here. I either would have gotten out break even or I would have held short, hoping that this is the start of a swing down. Bear breakout, probably at least one more leg down. Well, we got one more leg down, and look what we have now. Another bull bar closing on its high. You can call it a micro double bottom or a small double bottom, a lower low double bottom. In any case, the bears who sold this close, what are they doing now? Are they selling more? No, they're giving up. This is a sign that the sell the close bears were sufficiently disappointed by this bar that they wanted to buy back their shorts when it got to around their close. Some of them held short briefly during this bar, but immediately afterwards, this is bears giving up. They were sufficiently disappointed by this. A whole bunch of them started buying back their shorts when it got back down to around that close, and this is bears buying. and it's aggressive bulls buying as well, betting that the bears would give up. This is not a strong sell-off. The bars are relatively small, prominent tails, a lot of trading range price action here. Disappointment for the sell to close bears here. A lot of the bears gave up, and a lot of the bulls bought for a scalp up. You can also call it a wedge channel. One push down, reversal, another push down, reversal, push down, reversal. Different ways to look at it as a wedge. You can say this is the first push, second push, third push. This could be the first push on some computers, second push, third push. Different computers see different things, but most computers see this as a weak bear trend, probably a bear leg in what will become a trading range, which means we'll probably get a bull leg before long. We have a double top bear flag, and we're also around a measured move down. It does not matter if you use this high or that high for the measured move projection. In either case, we're around that measured move target. I gave some very specific scalping examples in this video. Again, most traders should focus on swing trades. However, if you spot a reasonable scalp and you think you can manage it correctly, go ahead, take it. It's reasonable to do. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 5 videos on scalping. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on scalping examples. I'm going to be continuing the chart from the prior video, again discussing scalping setups and management. The E-minis sold off in a spike pullback channel, and we have a couple bull bars closing near their highs. This is a reasonable swing buy setup. We have an upper trading range, we have a couple of reversals, we have a bear breakout and a second leg down, both closing on their highs. The follow through after the reversals down has been bad. Bear breakout, bull bars, bear bar, bull bar, bear bar, bull bar. 2, 3 bear bars, prominent tails, and then a bull bar closing on its high. Another pair of bear bars, bull bar closing on its high. When you have bad follow through like that, the sell-off is probably a bear leg in what will become a trading range. A bear leg in a trading range is usually followed by a bull leg in a trading range. Therefore, this is a reasonable swing buy setup. You have a micro double bottom, you have very good buy signal bars, you have a bear breakout and a second leg down, reversing up, and you have an upper trading range, a magnet above, and the sell-off has had bad follow-through on the way down. However, you do not have to swing trade it. Sometimes it's reasonable for scalpers to take scalps when there's a reasonable swing setup. There are many ways to handle entering here. One is to buy above the high of this bar with a stop. Another is to buy the close of the follow-through bar. It has a bull body. Even though it's only a one-tick bull body, it's a bull body, so that's reasonable. Some traders will buy with a limit order on the close of this bar or on the close of that bar. A bull scalper looking for a 1-point scalp. For whatever reason he buys that close, this close on a stop above this bar. His 1-point profit target is here, right at the moving average. You'll have bear scalpers who will sell a strong bull close at the moving average, especially given that the follow-through was not all that aggressive. It's only a 1-tick bull doji, so some bear scalpers will sell at the moving average or the close of this bull bar for a scalp down. We have a double top bear flag, and we're at the moving average. The close of the bull bar was not above the moving average, and the follow-through bar has a bear body. It's a low 2 short, low 1, low 2. Every double top is a low 2 short, but there probably are buyers below this bar because the reversal up is good enough so that the traders will get at least a second leg up. The probability favors a second leg up. We have 3 bull bars, 2 with decent sized bodies closing on their highs, and we have another bar here for a double bottom. If traders buy with a limit order below this bar, their stop is down here. And most traders who take that trade are willing to buy more lower to scale in. A weak sell setup, a double top, but we're probably always in long, and we only have a doji sell signal bar, so bulls will buy the low, betting that the sell will fail, and they'll put a stop below the bottom of the bull trend. Remember, the bulls are betting that this is the start of a swing up, and therefore they need the market to continue to form higher lows. They do not want any sell-off here to fall below this low. They believe this is the start of a bull trend, and the pullback should not fall below the start of the bull trend. If he's a scalper, he buys that low, places a limit order to get out 1 point above, he takes his profit. Bull breakout, a surprisingly big bar. Usually when you get a surprise bar, you'll get at least a small second leg up. We have a bear channel. Usually it evolves into a trading range. It's possible that this is a second leg trap in a trading range. First leg up, pullback, and then a strong breakout, but a lower high, and it could trap bulls into buying high. Probably we're going higher. There's room to the top of the range, and this is a surprise bar big enough so that even if it does turn out to be a second leg trap, the bulls will probably get at least a small second leg up. Therefore, bulls can buy that close and put a stop either below the buy climax bar or below this minor higher low. However, because the bears have a potential wedge, first push down, second push down, and then a failed breakout above this double top, if we start to reverse, that would be a third push down, the bears will sell this close as well. Remember, look to the left. Trading range. Big bull bar, traders made money selling the bull close. Big bear bar, traders made money buying the bull close. Bull breakout, traders made money selling the bull close. A bear bar, outside down, they made money buying the bear close. If you bought this close, you could buy more lower and you were able to get out with a profit. A big bull bar, we went down. Bears made money selling this close. Bulls made money buying this close, a bear breakout. Therefore, with all of the reversals after strong trend bars, the bears will sell this close as well, betting against a sustained strong breakout and the start of a bull trend. They'll bet instead on terrible follow-through because, look to the left, every strong trend bar has had terrible follow-through. In a trading range, usually bulls and bears can make money buying or selling at any time if they use wide stops and scale in and manage their trades well. This is a good example. Here's the bull case. The bull buys that close, he puts a stop down here, betting that we'll get at least a small second leg up before we get a reversal down. He can buy more 1 point lower or at the low of this bar, betting against the reversal. And then he places a limit order to get out at his first entry price here, break even on his first buy, and then with a 1 point profit on his lower buy. He may have had a limit order to buy more, another point lower, or even another point below that, but those orders were not filled. He has to trade small enough so that however many times he's willing to add to his position, if he gets stopped out, the loss is no greater than on any other trade. I said bears can sell that close and make money, and they can. A bear selling that close needs the market to stay below a major lower high. This is a double top. We have a series of bear bars and a new low. This is a major lower high. And therefore, bears will sell this close, scale in higher if they have to, looking for a 1 point scalp. And it fell 1 point on the very next bar, and they can exit with their 1 point profit. They were willing to scale in higher if they had to, but if the market immediately goes their way, they just take their profit. Four bear dojis. It's important that the bodies are shrinking and that the bodies are not particularly big. However, it's bad follow-through after a bull breakout, and therefore this small bull flag might be the final bull flag. Remember, I said the bulls were expecting at least a small second leg up. Well, it might be a small leg up, lasting just 1, 2, 3 bars. This is a potential final bull flag. And because of that, and because of all the trading range price action, bears will place a limit order to sell at the high of that bar. They'll scale in higher. Their stop is above the top of the most recent major lower high. Remember, bulls made money buying that low. Bears made money selling that high. And even the bulls who bought the breakout below this double bottom made money if they used wide stops and scale in. Bulls made money buying below here. Bears made money selling there. A lot of profit for limit order traders, and therefore bears will sell above this high, betting that we'll get some profit taking and at least enough of a sell-off for a 1-point scalp. And they did. The next bar, the market fell enough for them to get out with a 1-point scalp. Three consecutive bear bars, one closing on its low with a decent sized body. That is not good for the bulls. Whenever you get a leg up, especially in a trading range, and then you start to get a reversal down with 3 or more consecutive bear bars, the odds are there'll be sellers above and the first reversal up will fail and form a lower high. Also, it's a second leg up, 1 pullback 2, and it's a consecutive top pattern. The bears had a double top bear flag here. Instead of getting a swing down, we got a bull breakout, and now we're having a second complex top. A complex top, 2 legs up, another complex top, 2 legs up. So it's a type of low 4, even though this low is below that low. The bears tried to reverse down here, failed. The bulls got a breakout and a second leg up, and that means a second sell signal. Usually you're going to get a couple small legs down from that. Because of that, the bears will sell at the high of the prior bar, betting that it'll form a lower high. They'll place a limit order to sell at the high of this bar, and they'll get filled here, and they'll put their stop up there. And they're willing to scale in higher. In this case, they did not have to. The market immediately went down to their profit target, and they exited with a limit order 1 point below their sell entry. You could call this a bull trend and a high 1 buy, but the tail on the top of this bar and the 3 consecutive bear bars made it a low probability bet. Also, you can call this a wedge, 1, 2, 3, or 1, 2, 3, 4, and a low 4 short, low 1, low 2, low 1, low 2. Maybe we'll get a deeper pullback to the bottom of this buy climax, maybe even a test of the low of the day. For the bulls, now they have a wedge bull flag, 3 pushes down, 1 pullback, 2 pullback, 3. Does not matter that the pullback from the first leg down went to a new high. It's still part of the correction process from this breakout. The bulls have a micro double bottom, a decent buy signal bar. This is a reasonable buy. Also a double bottom, a test of the bottom of the buy climax. Did not quite get there, and that is a problem. It lowers the probability for the bulls looking to buy here. Normally, when you have a buy climax bar and then a correction, and it gets close to the low of the bar, it has to get to the low of that bar. And you can see what happened. We reversed down. I'm not opposed to taking this buy. However, usually when I see an obvious magnet and it's within a point or two of where the low is, the odds are the market has to get down to that magnet, and it makes me hesitant to buy, even though we have a wedge bull flag, and it is a reasonable buy. So bulls who did take that buy, they would get out below here. However, they would look to buy a reversal up. Some bulls who took that buy would buy more here, betting against a bear trend. We have a failed buy signal, a double top bear flag, early bear trend, double top bear flag. We have a failed high 2 buy, and it was a reasonable buy. You have to be wondering if we'll get a couple legs down. Some bears would sell on a stop below this bear bar, betting on a double top bear flag, a low 2 bear flag, and at least a little bit more down. Also, the bulls who bought above this bull bar thinking they had a wedge bull flag and a small high 2 would be disappointed by this bear bar closing on its low and many of them would get out either below that bear bar or below this bar. Therefore, it's a reasonable short. They get out with a 1-point scalp. The day is a scalping day. Obviously, you could take some swing trades, but a lot of traders would scalp. This is another surprise bar. We have a big tail on the bottom of this bar, so you'd think that we're continuing with the trading range price action, but now we have another bear bar closing in its low. We have 3 consecutive bear bars. We have a wedge bull flag, and we have 3 consecutive bear bars breaking below the low of that wedge bull flag. That increases the chances that this breakout will have at least one more small leg down. Therefore, this reversal up probably will fail. There probably will be more sellers than buyers at the high of this bar. Possible measuring gap, we have a wedge bull flag, a bear breakout, 3 consecutive bear bars, possibly a measured move down. Some traders will sell that strong bear close, especially since it's the 3rd bar down. Others will sell with a limit order at the high of this bar, or they'll sell this close and sell more 1 point higher, 2 points higher, stop above the top of the bear leg. Not that far above, just a little bit above. Bears selling this close, some might add on here. It's about 1 point above their original entry. When you're scaling in, normally you want to make sure your second entry is at least the size of a scalp above your first. The idea is, once you get the reversal up, you're trying to get out break even on your first entry, and you want to scalp profit on your second entry. So you want your second entry to be at least the size of a scalp. So when it gets back to the first entry, you make a profit, a scalp profit on the second. Is this becoming a sell the close bear trend? It might be. It's not particularly strong, but we have 3 bear bars and a break below, an attempt by the bulls to form a higher low major trend reversal. Bear trend, bull breakout, and a higher low, and it's a wedge higher low, so it's a good looking buy signal. But we got 3 consecutive bear bars, and that is a fairly strong rejection of the buy argument. Some bears will sell closes. Every strong bear close, they'll sell the close, stop above the most recent either minor high or more major high, again looking for 1 point scalps. At fellow point, they exit. Other bears will say, that's another bear bar closing on its low. Isn't that another sell the close bar? Yes. So if a bear had a limit order to take a 1 point profit, they got filled, and then he sees another bear bar closing on its low, he can immediately sell again for another 1 point scalp. Also, there's room to the low of the day. We have a high, a lower high, a lower high. It looks like a trading range, but it could also be a broad bear channel. And if so, we should get down to the low of the day. And there's room from this close down to the low of the day for a scalp. We have a sell the close bear trend, but now we're getting a tail on the bottom of the bar. Also, we've had 3 bear bars and 3 more bear bars and a lot of trading range price action, and we're near the low of the day. Whether this is a trading range day, which it is, or a broad bear channel, which it is, we don't know at this point. However, in both cases, the market usually finds buyers around the prior low. This is not a good location to continue to sell closes because we broke to the new low and there may be enough buyers there for the market to bounce. Remember I said bulls were buying below bars and scalping, bears were selling above bars and scalping, bears selling above, even selling above here, adding on, scaling in, and then getting out, buying below here and scalping up. Well, guess what? A new low of the day. Yes, 6 of the past 7 bars have bear bodies, but the bear bodies are not especially big. And we have a tail here, bad follow through here, big tail here, new low of the day. Well, a lot of scalpers will buy with a limit order at this low and get filled here. Other traders will look to scalp on a reversal up, or maybe if we get a micro double bottom and then a reversal up. Bear trend, bull breakout, lower low, major trend reversal, 3 pushes down, 1 pullback, 2 pullback, 3 pullback. It's a very tight bear channel. The first reversal up probably is minor. However, given that it's a trading range day, a lot of bulls will look to buy. We're around a measured move down. Remember, the bulls had a wedge bull flag here. We got a bear breakout, and therefore traders expected 2 legs down, 1 pullback, 2, and they expected this to be a measuring gap. In other words, there would be profit takers around a measured move down, especially since it's at the low of the day. Many of the bears who did hold and took profits here, they created that tail, are willing to sell again, but probably after only a couple legs up, which means a lot of the bears will not sell the first reversal up, and therefore bulls will buy for scalps. You can buy above the high of this bar. You can either put a stop below the low here or use a wider stop. Some bulls will buy here, and they'll place a limit order to buy more if it falls below that bar. They'll trade small enough so that if they add to their position, their risk is no bigger than on any other trade. If they buy here and it simply goes up, they'll take their profit. And that's what happened here. Three consecutive bull bars, all closing above their midpoints. 2 closing relatively close to the high. Therefore, if the bears try to get a continuation down, probably buyers at the low of the prior bar and at least a small second leg up. It could be an early buy the closed bull trend. Very tight bear channel, probably the first reversal up is minor. However, because of the 3 bear bars reversing up from the bottom of a trading range, probably we'll get at least 2 legs up. We don't know if we'll get a 4th, 5th, 6th bar in a row, and therefore traders might start buying closes. We do know that if it reverses down, there probably will be buyers below and we'll get a higher low. So bulls buying this close can buy more lower and put a stop down here, confident that they'll be able to get out break even on their first entry and with a profit on their lower entry. Instead of going down, we went sideways, and the bull scalpers were able to exit here with a 1-point scalp. I gave some more scalping examples in this video and how to manage the trades. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on scalping examples.